Principle 2. Common mistakes and contrarian investing. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." This is a core principle in his investment philosophy, helping him avoid common mistakes that many investors tend to make. So, what are these common mistakes? Buffett points out that investors' psychology is often influenced by past success, and they frequently fail to properly assess current factors. He warns, investors always look to the past, and when they see that a lot of money has been made in recent years, they rush in and push prices up. However, relying on past achievements without considering the present situation can lead to poor investment decisions. Buffett always advises that one should never make decisions based solely on what others are doing or saying. Instead, maintain an independent perspective and focus on analysis and factual data. A perfect example of what Buffett warns against is the dot-com bubble of the late 1990s. During that time, investors witnessed the rapid growth of tech and internet companies, driving them into the market and pushing stock prices higher, despite many businesses not having a clear business model or actual profits. Investors were swayed by the quick successes of companies like Amazon, Yahoo, and eBay in the previous few years and believed the trend would continue indefinitely. When the bubble burst in 2000, many investors suffered significant losses. Relying on past success and following the crowd led to poor investment decisions instead of carefully considering the current factors and long-term potential of the businesses. This is exactly what Buffett advises against. Investors should focus on factual analysis and not let past successes or current market trends cloud their critical judgment. Regarding Principle 2, the billionaire advises, never make decisions based on what others are saying or doing. Buffett emphasizes that you are not right because others agree with you, but only when your analysis and data are correct. A successful investor must think independently, be willing to differ from the crowd, and avoid herd mentality. Contrarian investing means holding a viewpoint on the market that is out of favor, and then doing the necessary research to determine if there's an investment opportunity. Successful contrarian investors must be willing to spend a lot of time evaluating market conditions to build their case. Since the beginning of his investment career in 1956, managing a fund of $100,000, Buffett became known as a contrarian. He did not work on Wall Street, choosing Omaha as his base, and did not disclose to his partners where he was investing. Many people thought he would fail, but 14 years later, his initial investment had grown to over $100 million. Buffett has always believed in going against the crowd. He focuses on buying quality companies when the market is overly pessimistic and their stock prices have been driven down. Conversely, he sells when investors become irrationally optimistic and push prices too high. By recognizing market sentiment and acting contrary to it, Buffett capitalizes on opportunities created by the emotional reactions of other investors. In this way, he buys at low prices and sells at high prices, optimizing returns while minimizing risk. During periods when the market is booming and investors are excited by profits, Buffett holds on to cash and avoids buying more. But when the market is consumed by fear and deep pessimism, he builds strong positions in the best companies. Principle 3. Invest in businesses you understand. Warren Buffett has always emphasized, never invest in a business you cannot understand. When he says understand, he doesn't just refer to knowing what the company's product is, but also understanding how the business model works and how the company's economy will evolve over the next 10 to 20 years. For example, Buffett shared that he can easily predict how the economy of a chewing gum company like Wrigley will look over the next decade, because the internet won't change the way people chew gum or the type of gum they choose. He consistently adheres to the principle of only investing in businesses he truly understands. A prime example is when Bill Gates introduced Buffett to the potential of Microsoft computers, but Buffett declined to invest because he did not fully understand the technology industry at that time. Instead, he focused on companies he was more familiar with, like the chewing gum company. Buffett does not only rely on product knowledge but also applies a rigorous evaluation process before making an investment. He bases his decisions on 5 key criteria. 1. Sustainable competitive advantage. 2. Outstanding management team. 3. High return on equity. 4. Strong internal growth potential with attractive profits. 5. Reasonable purchase price. Another outstanding example that demonstrates his understanding of a business, along with the ability to foresee its future, his decision to invest in Berkshire Hathaway in December 1962. At that time, Berkshire Hathaway was a struggling textile company on the brink of bankruptcy, with a stock price of just $7.50 per share. While statistically, this was a cheap stock and a bad company, Buffett saw an opportunity in the low price. Even though it was a poor company to invest in, he predicted that Berkshire Hathaway would shut down its factories, free up capital, and repurchase shares. Buffett bought in, expecting the company to eventually make a public buyback offer, providing him with a modest profit. As expected, Berkshire did make an offer to buy back 7% of the shares that Buffett held, at a price of $11.50 per share. However, the company's CEO at the time, C. Barry Stanton, later sent a letter offering a reduced price of $11.375 per share, making Buffett feel deceived. He refused to sell and began buying more shares until he gained control of Berkshire Hathaway.